This week, gold crossed $4,000 per ounce. Every financial news outlet covered it. Safe haven demand, geopolitical risk premium, inflation hedge, central bank buying. The explanations were consistent and they all focused on the same question: why are people buying gold? Nobody, not one mainstream financial outlet, asked the more important question: what does it mean that you now need $4,071 to buy the same ounce of gold that cost $35 in 1971? Because here is what has not changed since 1971: gold. An ounce of gold today is physically identical to an ounce of gold in 1971. It has the same atomic weight, the same chemical properties, the same industrial applications, the same aesthetic qualities. Gold did not improve. Gold did not become more useful. Gold did not develop new capabilities that justify a higher price. What changed dramatically, continuously, and in ways that this series has spent 19 videos documenting in precise historical detail is the dollar. The currency that in 1971 was defined as 1/35th of an ounce of gold is today worth 1/4071st of an ounce of gold. That is not a gold story, that is a dollar story. And the number 4071 is not a prediction, not an analysis, not a forecast, it is a historical record. To understand what dollar shift is unwindmid today, you need to understand what 1350 odd meant in 1950 quart, because that number is where the story of gold's dollar price actually begins. The Bretton Woods Agreement of 1944, examined in the second video of this series, fixed the dollar to gold at $35 per ounce. This was not an arbitrary number. It was the rate at which the United States committed to exchange any foreign central bank's dollar holdings for gold on demand. It was the anchor of the entire post-war international monetary system. $35 per ounce meant that the dollar was defined as 1/35th of an ounce of gold. Every dollar in circulation was, in principle, a claim on a specific quantity of gold held in American vaults. The dollar's value was not a matter of confidence or convention. It was a contractual relationship backed by the physical gold that the United States held. At the time of Bretton Woods, approximately two-thirds of the world's monetary gold stock. This anchor performed its intended function for 27 years. From 1944 to 1971, the dollar's purchasing power relative to gold held at $35 per ounce, maintained by the Federal Reserve's management of dollar supply and the U.S. government's commitment to honor the convertibility pledge. Countries that accumulated dollars could exchange them for gold. The system was stable precisely because the anchor was credible. What the anchor also did, and this is the dimension that monetary historians emphasize, was impose discipline on American fiscal and monetary policy. The US government could not run persistent large deficits financed by money creation without depleting its gold reserves, because excess dollars would flow back to the Fed for gold conversion. The anchor was not just a price peg, it was a constraint on the government's ability to spend beyond its means through monetary expansion. When Nixon removed the anchor in 1971, he removed not just the price relationship but the constraint. From that moment, the dollar's purchasing power became a function of Federal Reserve policy, congressional fiscal decisions, and the confidence of dollar holders, with no hard external check on any of these factors. The price of gold in dollars has been the market's running assessment of how well those factors have been managed in the absence of the hard constraint, and the verdict, read across 55 years of data, is recorded in the number 4,000. The dollar price of gold since 1971 is not a smooth line. It is a record of 5 distinct phases, each corresponding to a specific set of monetary and fiscal conditions, and each revealing something specific about the dollar's structural position at the time. The first phase is the initial break, 1971 to 1918. 20th, from the day Nixon closed the gold window at $35 per ounce, gold rose to $850 per ounce at its January 1980 peak, a nominal increase of approximately 2,300% in 9 years. This was the market's initial repricing of the dollar after the removal of the gold constraint. The 1973 oil embargo, the Burns Fed's monetary accommodation, the double-digit inflation of the late 1970s, and the progressive loss of confidence in American monetary management. all contributed to a decade in which gold's rising dollar price was the most accurate real-time indicator of the dollar's declining purchasing power. The peak of $850 in January 1980 corresponded to the moment of maximum monetary stress, the point at which the Burns-era monetary policy had produced an inflation dynamic so severe that Volcker's extreme intervention was the only remaining option. $850 was the market's assessment of the dollar at the nadir of its post-Bretton Woods credibility. The second phase is the Volcker restoration, 1990 to 2000 Volcker's brutal tightening, interest rates to 20%, deliberate recession, broken inflation, restored confidence in American monetary management. Gold fell from $150 in 1950 to approximately $250 per ounce by 1999 and 2000. The falling gold price was the market's reward to the dollar for the discipline that Volcker imposed and that Greenspan maintained. A dollar that could be trusted to hold its value did not require a gold hedge. The gold price falling was not a statement about gold. It was a statement that the dollar, under Volcker and Greenspan, had re-established the credibility that the Burns era had destroyed. The third phase is the post-2000 wind structural shift, 2000 il to 2000 il Alger. From its $2,050 low around 2000 il, gold began a decade-long ascent that reached 1,921 per ounce in September 2000 il Adja. This ascent corresponded to three major structural developments: the abandonment of fiscal discipline following the 9 Ildiris attacks and the subsequent wars in Afghanistan and Iraq, the Federal Reserve's response to the 2000 will recession, and then the 2000 yield financial crisis through sustained low interest rates and quantitative easing, and the first visible signs of the de-dollarization trend as China and other emerging markets. Central banks began diversifying their reserve holdings. The $290 il-isim was not the same kind of maximum stress signal as the 1850 bikre in 1980. In 1980, the dollar was under acute, crisis-level monetary stress. In 2000, the dollar was under structural, gradually building stress, the early stages of the debt cycle dynamics and reserve currency pressures that this series has documented throughout. The alternate 1921 price was the market's assessment of those structural pressures at a moment when they were visible but not yet acute. The fourth phase is the QE era consolidation. The most direct way to understand what gold at 4071 means is to perform the purchasing power calculation that financial media consistently avoids because its implications are uncomfortable. In 171, $1 was defined as 1/35th of an ounce of gold. At that ratio, 1 ounce of gold could be purchased for $35. Today, 1 ounce of gold costs $4,071. This means that the dollar measured against gold has lost approximately 99.1% of its 1971 purchasing power. $1 today buys 1/4071st of an ounce of gold, approximately 0.05% of what it could buy in 1971. This is an extraordinary number. It does not mean that all dollar-priced goods and services have risen by the same proportion. The productivity improvements of the past 55 years have kept many goods significantly cheaper in real terms than the gold-based calculation would suggest. But it does mean that gold, the monetary metal that has served as the standard of monetary value for 3,000 years, is telling us something specific about the dollar's trajectory since 1971 that the official inflation statistics do not capture in the same way. The official cumulative CPI inflation from 1971 to 2030 to the face shows approximately a 6-month fixings today. This is the official measure of dollar purchasing power loss. Gold's measure is different. It shows an 1,000% increase in the dollar price of gold over the same period, meaning that the dollar has lost far more of its value relative to gold than relative to the general price level. The gap between the CPI measure and the gold measure is significant and revealing. It reflects the fact that gold captures monetary debasement, the expansion of the dollar money supply relative to the real economy, in ways that CPI, which measures consumer prices, does not fully capture. The question that this calculation forces is which measure is more relevant for assessing the dollar's long-term purchasing power. For everyday consumer goods, CPI is more relevant. For the question of whether the dollar is maintaining its role as a reliable store of monetary value over long periods, the specific question relevant to reserve currency status and the wealth preservation themes of this series, gold's measure is the more informative indicator, and gold's measure says the dollar has lost 99.1% of its purchasing power relative to the world's oldest monetary standard since 1970. The most important confirmation of what gold's dollar price is telling us comes not from the gold market itself, but from the behavior of the institutions whose primary professional responsibility is to assess monetary risk, the world's central banks. As documented in the second video of this series, central banks have been accumulating gold at the fastest pace in recorded history for the past 3 years. The World Gold Council's data shows central bank gold purchases of over 1,000 tons in both 2022 and 2023, and elevated purchasing continuing through 2024, 2050, and into 2026. This accumulation is occurring simultaneously with gold at $4,000 per ounce, meaning that the institutions buying gold are buying it at the highest dollar price in history. They are not buying cheap. They are buying at a price that implies they believe gold at $4,000 is still undervalued relative to the risks they are hedging against. Central bank gold buying decisions are not made by retail investors responding to price momentum or financial media narratives. They are made by professional reserve managers with access to the most comprehensive monetary and geopolitical risk data available to any institutional actor. When those managers are buying gold at $4,000 per ounce at the highest price in history, they are making a specific and considered judgment that the monetary risks they are hedging against are sufficiently severe and sufficiently likely to persist or intensify, that the price they are paying is justified. The specific risks driving central bank gold accumulation are the same risks documented throughout this series. The weaponization of dollar reserves demonstrated by the Russian asset freeze, which showed that dollar assets held in Western custody were political instruments subject to confiscation. The fiscal trajectory of the United States, which shows no credible path to reducing the debt burden without either severe austerity, significant inflation, or some combination of monetary and fiscal measures that would reduce the dollar's real value. The structural de-dollarization of global trade and reserve management, which is reducing the automatic demand for dollars that has historically supported its purchasing power. Central banks are not buying gold because they think it will go to $5,000 next year. They are buying gold because they are preparing for a world in which the dollar's reserve currency status provides less reliable value preservation than it has for the past 80 years. At $4,071 per ounce, that preparation is continuing. The Federal Reserve's July 28 FOMC meeting, occurring in the same week that gold has crossed $4,000, creates a specific analytical paradox that deserves careful examination. The expected Fed rate hike this week is, in conventional monetary theory, gold negative. Higher interest rates increase the opportunity cost of holding gold. The metal pays no yield, and as the yield available on dollar cash or dollar bonds rises, the relative attractiveness of holding zero-yield gold declines. This is the mechanism that caused gold to fall when Volcker raised rates in 1981. The same rates-gold inverse relationship that has characterized every tightening cycle in the modern era. But gold at $4,000 rising through a period of already elevated interest rates and unexpected further rate hike is not following the conventional pattern. The conventional inverse relationship between rates and gold has been breaking down, the same breakdown that characterized the 2022 to 2024 period, when gold rose even as the Federal Reserve implemented the most aggressive tightening cycle since Volcker. This breakdown is itself a signal. The conventional rate-gold relationship assumes that higher dollar yields make dollar assets more attractive relative to gold. That assumption holds when the dollar is trusted, when investors believe that the higher yield compensates for the risks of holding dollar assets. When that trust erodes, when the structural concerns about the dollar's purchasing power trajectory outweigh the yield differential, gold can rise even as rates rise. The current gold price at $4,000, rising through a Fed tightening cycle, is the market statement that the structural concerns about the dollar's trajectory are currently outweighing the yield differential that higher rates provide. This is a specific and historically significant signal. It appeared in the late 1970s as the precursor to the $850 peak, and its reappearance now suggests that the market is pricing a structural monetary concern that rate hikes alone cannot resolve. Wash's expected rate hike this week will not, if the current gold price's signal is accurate, produce the gold price decline that conventional monetary theory would predict. It may produce a temporary pullback as rate hike certainty gets priced and the event risk premium is removed. But the structural dynamics driving gold to $4,000 are not amenable to resolution through 25 basis point rate increases in an environment where the underlying fiscal trajectory has not changed, where the petrodollar vulnerability persists, and where the de-dollarization trend documented in this series continues to accelerate. One of the most analytically useful properties of gold's dollar price is that it functions as a single number that synthesizes the effects of multiple structural mechanisms simultaneously. Unlike individual economic indicators, which measure specific dimensions of economic activity, gold's dollar price reflects the aggregate judgment of the global market about the dollar's monetary reliability across all dimensions simultaneously. This makes the current gold price a useful synthesis of the 19 mechanisms this series has documented. Bond market stress, higher treasury yields reflecting reduced confidence in the dollar's fiscal trajectory is gold positive, because higher yields on a depreciating currency are less attractive than they appear. The gold price at $4,000 incorporates this. Central bank gold accumulation documented in the second video directly supports gold demand and therefore prices. The gold price at $4,000 incorporates this. Petrodollar vulnerability, the Hormuz conflict, and its implications for the energy security architecture underlying dollar demand is gold positive because uncertainty about the petrodollar's stability increases demand for hard monetary assets. The gold price at $4,000 incorporates this. Middle class wealth destruction and financial repression, the transfer of wealth from savers to asset owners documented in the fourth video, drives demand for gold as a savings vehicle that cannot be inflated away. The gold price at $4,000 incorporates this. Dollar sanctions weaponization, documented in the fifth video, has driven central banks to diversify into gold as an asset that cannot be frozen or confiscated. The gold price at $4,000 incorporates this. Internal political fragmentation, documented in the sixth video, reduces confidence in the institutional stability of the United States and therefore in the reliability of dollar-denominated assets. The gold price at $4,000 incorporates this. Reserve currency timeline, documented in the seventh video, places the current moment within the transition window that every previous reserve currency has faced, increasing demand for assets that preserve value across transitions. The gold price at $4,000 incorporates this. Stalled disinflation acknowledged by the IMF. The historical precedents for gold at structurally elevated price levels reached during periods of genuine monetary and geopolitical stress rather than speculative bubbles produce a specific set of observations about what tends to follow. The first observation is that structurally driven gold price levels tend to be stickier than bubble-driven ones. The $850 peak of 1980 was driven by a combination of genuine structural monetary stress, the accumulated effects of a decade of monetary mismanagement, and speculative momentum. When Volcker's tightening broke the monetary stress, gold fell back sharply and spent the subsequent 2 decades well below its 1980 peak. The structural stress resolved, the gold price resolved with it. The old 1929 image peak of 2011 was similarly followed by a multi-year consolidation as the immediate structural concerns that drove it, the post-2000 wide QE expansion, the European sovereign debt crisis, the peak of the US debt ceiling confrontations, partially resolved or stabilized. Gold spent the subsequent decade below its 2011 peak. The current level of $4,000 is being reached in an environment where the structural mechanisms driving it, the debt trajectory, the petrodollar vulnerability, The de-dollarization trend, the stalled disinflation, are not obviously approaching resolution. This distinguishes the current price from the 1980 and 2011 peaks, which were reached at moments of maximum acute stress that then partially resolved. The current price is being reached at the moment of continuing multi-year structural stress accumulation without clear resolution mechanisms. The historical cases where gold sustained elevated price levels where it did not fall back to pre-stress levels after reaching a peak are the cases where the underlying monetary structural change was genuine rather than cyclical. The transition from the gold standard era to the fiat era in the 1930s and 1940s produced a permanent structural shift in gold's price relationships that was not reversed when the immediate crisis passed. The 1971 Nixon shock produced a permanent structural shift that was not reversed when Volcker stabilized the dollar in the 1980s. The gold price at $4,000 carries specific implications for ordinary people's financial decisions that are different from and more important than the investment question of whether to buy gold. The first implication is about savings. A dollar held in a savings account earning 3% annually in an environment where gold's dollar price has risen from $2,000 in early 2020 to $4,000 today has lost approximately half its purchasing power relative to gold in 6 years. This is not the same as losing half its purchasing power in terms of consumer goods. The CPI measured purchasing power loss over the same period is significantly smaller. But for anyone holding savings with the intention of preserving long-term monetary purchasing power, gold at $4,000 is a signal that the dollar-denominated savings vehicle is performing its function less well than the official CPI measure suggests. The second implication is about retirement planning. The conventional retirement planning framework, accumulate dollar-denominated assets throughout your working life, convert them to income in retirement, assumes that the dollar will maintain its purchasing power in a way that makes dollar-denominated savings adequate for funding retirement consumption. Gold at $4,000, if it is reflecting genuine structural monetary concerns rather than temporary risk premium, calls this assumption into question for the long-duration retirement savings of people who are currently in the early or middle stages of their careers. The third implication is about geographic diversification. Gold at $4,000 is a global signal. It reflects dollar purchasing power loss measured in a globally traded asset. Countries and currencies that have maintained better monetary discipline than the United States, Switzerland, Norway, Singapore, have seen their currencies appreciate relative to the dollar even as gold has risen in dollar terms. The gold signal is not just a statement about gold, it is a statement about relative monetary reliability across currencies, and it points toward geographic diversification as a component of any long-term wealth preservation strategy. The fourth implication, and the one this series has returned to most consistently, is about the importance of understanding the historical pattern rather than reacting to the current data point. Gold at $4,000 is not an instruction to buy gold today. It is a data point in a pattern that this series has documented across 19 videos. The pattern began long before $4,000, and the wealth preservation decisions that are most historically validated are the ones made early in the pattern recognition process, not the ones made when the $35 in 1971, $850 in 1980, $1,921 in 2011, $4,071 today. These are not gold prices. They are dollar confessions. Each number is the market's running assessment of what a currency worth its weight in promises has delivered in terms of actual monetary reliability since the day the last constraint on its creation was removed. Each number tells the story of a fiscal decision, a monetary choice, a geopolitical arrangement, and what those decisions have meant for the purchasing power of every dollar held by every ordinary person who trusted the currency to maintain its value. 4,071 is the most recent number, and that confession is not the last. This series has spent 19 videos building the framework to read what that number means. The bond markets, the gold accumulation, the petrodollar, the middle-class wealth, the sanctions, the internal politics, the timeline, the asset classes, the ceasefires, the Fed chair, the treasury sales, the alliances, the convergences, the stagflation, the bypass, the institutional admissions, and the banker who walked away. All of them are saying the same thing. Gold at $4,071 is saying it in the oldest and most direct language monetary history knows. Subscribe. because this channel translates that language, and it translates that language, and it translates that language